Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and a green-looking Nigel back from the hills. I think the color of the hills. Morning, Nigel. Back.
Well, morning, guys. Good to be back. And yeah, I think that's what the designers thought this morning. That since they've seen me with so much of green, put some green. Because I asked them over the weekend. I said, "What am I wearing?" They said, "Green." I said, "Why?" They said, "Because probably there's no much green on the screen." But let's hope better times for the markets. It's been a rough past week. I was just updating myself, and hope things turn around.
Yeah, it was the worst, weekly fall that we've seen in the last 3.5, 4 years. The auto index was down nearly 10%. So, Prashant, it was a bruising fall, and now the conflict has entered the third week. And at least as of now, there seems to be no respite that you can see.
No, absolutely. And I think, we've been in those kind of markets which requires a little bit of standing up, right? Because this is the third week. And when we started this, it looked like, a couple of weeks, maybe 3 weeks, 4 weeks, 5 weeks, who knows? But now we're actually now entering the third week here. Let me just quickly run you through the sort of, top highlights as we've been doing, because, this is of course about oil prices, etc. And oil, by the way, is at about $103 a barrel as we stand right now. But there is the element of the news flow, right? So US struck near Iran's key export hub at Kharg Island. And Kharg Island is the single most important point through which Iran sends its oil out. 90% of the oil which Iran sends out, and by the way, Iran sends out, exports about 1.5 million barrels of oil a day. 90% of that goes out through Kharg Island. I mean, it's basically a boat ride away from the shoreline of Iran, and 90%. Now, the thing is, President Trump in his Truth Social post essentially said that he's not struck military infrastructure. And this has basically been, he's kind of struck, he's struck military infrastructure, but not oil infrastructure. Now, Iran's response is still awaited. We don't know. The general assumption was that they will stay away from Kharg Island and will not hit it, but it looks like they have. So will Iran respond in a bigger way, wider way? And I think that perhaps has heightened fears of disruption to Gulf crude supplies in that sense. Let's move this along quickly, right? So Trump, of course, is also in his own style threatening to extend attacks to energy infrastructure if Iran interferes with the transit through the Strait of Hormuz. Trump said that Iran is ready to make a deal to end the war, but Trump basically saying that he wants better terms. So you got both sides, right, claiming Iran essentially saying that US wants to negotiate, but why should we negotiate? Trump is saying, well, Iran wants to negotiate, but, well, we want better terms as of now. The foreign minister of Iran essentially was on record saying that Iran has not asked for talks or a ceasefire. As I said, Wall Street Journal is reporting this morning that Trump administration will announce that multiple countries have agreed to form a coalition that will escort ships through the Strait of Hormuz. And I think this is important, right? The biggest reason why markets are panicked and markets are, in that sense, worried because oil is not getting through the strait. It's down to zero. And if ships can escort tankers through that strait, I think a lot of the problem will get started. But of course, it's not as easy as it sounds like. And Wall Street Journal is saying that sometime today, the Trump administration will announce that many countries have come together to do this. Now, some more comments here. It's basically who said what over the last 24 hours, 48 hours. Kevin Hassett, the National Economic Council, saying Pentagon estimates that the Iran mission could take 4 to 6 weeks to complete, but he didn't say whether 4 to 6 weeks is from the 26th of February or from today, or this is the new deadline from here out, and that's important. Energy Secretary Chris Wright saying this conflict will certainly come to an end in the next few weeks. I mean, these are all comments and little comfort to be derived from any of them, but these are still from senior officials out there. Now, I'll just quickly run you through the other sort of impact, right? There are so many implications of what's going on and the oil shock that we are seeing. Look at the 2-year yield, bond yield across developed markets. And I just looked at the US, Canada, Europe, and countries like New Zealand, Australia, etc. Just look at that. This is since the war in Iran began, 26th of February is the date that I've chosen, anything between 30 and 55, 60 basis points higher on the 2-year. The reason I'm putting this out is because, any hope that central banks around the world will step in, ease rates, that's disappeared, at least in the near term, because the implication is that on the front end of the curve, the market is telling you inflation is set to move higher. For how long is the question, but for now, maybe the moves are excessive, and sometimes it does happen, but the point is these are very large moves in just about, 10 trading sessions flat. Now I'll come to the market here. The Nifty fell 5% last week. The Nifty Bank fell 7%. These are large falls. Markets, of course, are oversold. The weekly RSI for the Nifty is about, 20 or 19 or 20. It can get more oversold. It can remain oversold for a while. Nifty's fallen 9% since the war began, which means that the Nifty lost about 2,350 points from the 26th of Feb, and we're down about 12% from the all-time high of about 26,373. Just look at that, right? 12% from the all-time high, 9% since the Iran war began. So bulk of the damage since the war started. We are already near 23,000 on the Nifty, and it's an important level. It's a level I said at the beginning of last week, perhaps we get to around 23,000 if there is no positive pushback. And we're already there, about 150 points away. So is this the point where perhaps your initial target kind of is met and you get a bit of a trading move higher? Let's see. Nifty Bank, similar numbers, 12% since the Iran war began. From the all-time high, it's down 13%. And here, the swing low is about 53,500. The question is, will we get a bit of a pause, a bit of a trading bounce from here? I think we'll just need to see. Now, this is just something we put out, I think, Tuesday or Wednesday last week. Now, historically, right, geopolitically induced oil shocks have always been a great buying opportunity. But there are two caveats here. There are two tail risks in that sense. And the two tail risks remain. One is an actual oil shock-led recession. We've got those in the past, 1973, 1980, 82. Who knows, right? We can all look at recent events and say, well, unlikely to happen, and it's in no one's interest to keep the war going. And the second is, if inflation goes up, as I showed you the 2-year yields, central banks actually don't loosen, they come in and tighten because they have to fight inflation, which is not great news for equity holders. So, geopolitical events and oil shocks have turned out to be over the last many years to be good buying opportunities, but you've got to be mindful that things can go the other way as well. So, got to be nimble, and of course, it's a lot of headline watching out there. But how's the F&O positioning looking like? And that's the big question. Nigel has got all of that. Nigel, over to you.
Well, we thought, the tide was turning in February when the FIs turned buyers. But the geopolitical issue has weighed on global equities and resulted in the FIs selling lock, stock and barrel in the Indian markets. And adding Friday's net sell number of close to around 10,000 crores, FIs have net sold close to around 63,000 crores, which puts them in the reckoning to challenge the recent record sell numbers that we saw in January 2025. And if you want to backdate a little bit more, then October 2024 is when we saw those record sell numbers. Hopefully, you don't get there, but we still have a few sessions in March. So that's a bit of a worry. The FI positioning in the F&O market as well is fairly cautious. They added a massive 36,000 short contracts. That takes the short positioning to around 90%. In absolute terms, it's around 2.6 lakh contracts. Additionally, they have been writing calls aggressively. 2 calls written for 1 put. Now, this has caused the PCR to approach the lower end of the range. Currently, it's at around 0.75. Remember, it's bottomed out at around 0.62, 0.63 or thereabouts. So, in the near term, it appears the bulls will at least look to defend the 21,700 mark, 22,000 odd mark. That, remember, is the Liberation Day low in April 2025, from where the markets bounce back. But, on the upside, it's turned into a sell on bounce kind of market. And the previous day high will be a key resistance level, which comes up for you on the screen at around the 23,500 odd mark. Now, consensus seems to be convinced that 10% correction in the markets, the Indian markets as well, is in the offing. The fear is that crude oil prices obviously spikes up to around $150 per barrel mark. But if that does not happen, then that Liberation Day low, that's going to be a very, very strong support at around that 21,700 odd mark. Additionally, the India VIX, well, that was up, even in Friday's trading session. But it didn't spike as much, if you're looking at that. In the past 2-3 trading sessions, we haven't seen that much of a big spike for the kind of corrections that you're seeing on the Nifty. Remember, on Monday, we saw a flare up in the India VIX, but after that, we have seen not such high moves out there. So the hope is that the fear index is gradually factoring in the worst case scenario for the Indian markets. Finally, the first half of March is seasonally weak, but this time around the pain was amplified, because the war took place, and that's why you saw exaggerated pain in the first half of March 2026 itself. Mild positive, though, is that the advance tax payment, the tax harvesting, for those that, however, made some profits, that's behind us. Now, history suggests dipping into a bearish market, an uncertain market, and keeping SIP flows, well, it's been rewarding for long-term investors. Hopefully, it plays out this time around. But the structure on the markets is a little bit weakish. We could see a bit of a bounce, but otherwise the structure is punctured. All eyes are on that Brent crude price. Will it flare up from here on? And the Liberation Day low of around 21,700, that's going to be a very, very strong support, at least in the near term.
Thank you very much for that. A quick check on Asia this morning. It's a mixed picture. The Japanese market, Nikkei, is down 1%. Kospi is flat. But the Taiwanese market is holding up in the green. Last week, remember, U.S. markets, the S&P was down nearly 1.5%, making it the third losing week in a row. Shanghai is also opened up mildly lower, at least it opened, but the economic data coming out of China has been fairly strong. So retail sales for the first 2 months of this year have gone up by 2.8%, beating economists' forecast of a 2.5% growth. Industrial output grew by 6.3%, again exceeding expectations of a 5% jump, though the investments in real estate continue to remain dampened. Matt Orton, Chief Market Strategist at Raymond James, is now joining in. Matt, thank you very much for joining in. Third week now. Do you get a sense that we're closer to the end, or do you think it's time to start pricing in a longer conflict? And what does that mean if you have to price in the fact that crude oil remains stubbornly high at $100 per barrel, and this goes on and on?
Hey, good morning, Rima. It's always great to join. And it's really hard to take a stance one way or the other with respect to what is going to unfold in the future. I think we've seen through this conflict playing out over the past 2 weeks that there's a lot of uncertainties around what the objectives are, what the end goal might be, what capitulation could potentially look like on either side. And so the main message I've been implementing in my own portfolios and that I give to all of our clients is this idea that diversification has to be tactical. Right now is the time to be in P&L preservation mode rather than trying to wade into the markets perhaps too early unless there are very, very compelling opportunities to do so. So over the past really a couple of weeks, even before this war started, I've been generally de-risking portfolios just because of other factors that I didn't like how they were playing out in the market, but I've aggressively de-risked over the past few weeks, and I'm perfectly fine sitting on elevated levels of cash, getting a shopping list ready for high quality assets with good balance sheets, revenues that are generally insulated from whatever is happening with respect to the war. And eventually we'll take the elevator back up. But there could be a couple more slashes, a couple more steps downward before we actually get to that capitulation moment with respect to the war. But the main concern is the longer that this plays out, the longer that the strait is closed, it increases the probability of elevated oil prices. And this is not something that a ceasefire can immediately turn back on because we're turning off production in the Middle East, and that takes a while to get back online. So there will be disruptions even after this war temporarily or permanently wraps up.
So aggressively de-risking, and now you're topping up on the cash holdings. What does it stand at right now?
Yeah, so my portfolio currently sits at about 15% cash right now. It's a little bit more tactical in nature, and we've been able to keep up on up days just by having some beta, at least in U.S. technology, semiconductors, memory names in particular, where revenues, margins are insulated from some of these concerns, as well as a little bit of exposure to energy that we've had from earlier this year. But a lot of early cycle cyclical names in the industrial sector, the material sector, a lot of emerging market exposure. A lot of that has been ratcheted down. I will be a buyer. I still like the longer term theme for emerging markets, especially ones that are more insulated from the oil challenges or that have exposure to commodities. I think they'll be beneficiaries longer term, so there will definitely be entry points. I just don't think we're there yet, and I'm willing to be a little bit late to make sure I'm comfortable as I put more chips back on the table.
Matt, hi, morning. Just your perspective on where we are here, because, markets have 11, 12, 13% kind of cuts from the highs on indices, Indian indices in that sense. But, I don't know if you look at technicals and charts, many stocks, and actually even the Nifty as of last Friday has broken the uptrend which was intact from the lows of COVID. That is, I think, May of 2020. So I mean, that's getting a fair bit of attention. I don't know how you look at it. And many stocks are at the lower end of that range, that channel, that upward channel from the lows of COVID. Do those become interesting ideas? I mean, or you start to get worried whether, this is now sort of ending something?
Prashant, it's a great point because when you start to break long-term trends, things do become a little bit more concerning. So I'm definitely on that side of the coin right now. Again, we can have a great bounce off of that and restart another up channel. But again, it's going to take a lot of momentum. It's going to take a big breath thrust in order for that to happen across, a number of different sectors and industries within the market. So right now, I treat a lot of these names that are breaking down both in India and across the rest of the world as guilty until proven innocent. And we just have to wait to have both the technical washout happening as well as ensuring that the fundamental perspective perhaps is not related to the technical breakdown. That's going to be where the best opportunities come, is where when you do your fundamental analysis, that the revenue streams are not impacted, that the margins may have a minimal impact from what's happening with respect to higher energy prices. And I think those are the names where you want to be looking for opportunities across a global perspective. And so that's where selectivity becomes really, really important to success moving forward. And the market is rewarding that. Dispersion remains at very, very elevated levels. And there's a lot of names across global markets that are in fact working. So there are things that are working, but right now I think you want to be a little bit more cautious and make sure that you're not catching a falling knife.
All right. Hi, Matt. Morning and good to see you, Ben. You've never shied away from, naming a few stocks. So, if hopefully things don't escalate from here on, what were the couple of names that you've looked at in the past? I think you've liked a couple of banking names, private sector banks, which have now pulled back a goodish bit. IndiGlobe Aviation, obviously, it's got a lot of headwinds currently. And Mahindra & Mahindra is another stock. So among these names, anything you'd be looking to dip into?
Hey, Nigel, I think M&M is a clear name to be looking to add exposure to once we get a little bit more clarity. It's obviously been treated with the rest of the auto complex with concerns around higher energy prices. Will people be as motivated to buy? But I think they're fairly well insulated from that, given their more premium strategy. And we also forget their exposure to the agriculture sector as well, where I think there's been a lot of favorable tailwinds from the budget. I think just from their margin overall with respect to that exposure. So M&M is a name that I think looks mispriced related to fundamentals. And I would also say a lot of the private banks look the same way. They've had a really, really rough past 6 months. And I do think that a lot of this behavior has just been technicals, now capitulation with respect to fear. It's been a one-way street with respect to flows. And I think the businesses themselves still look very solid. They're great ROE compounders. And so these are high-quality assets that are trading near Liberation Day lows. Those are names I want to start adding exposure to once I have confidence that the market's going to start to work again.
Okay, all right, Matt, thank you very much for joining us. Good speaking with you. And appreciate it. We'll take a break. We're going to just run you through the interactions which are lined up here on the program. So 8:35, Elara Capital's Jay Kale puts a spotlight on the auto sector. 9 o'clock, we'll be joined by Vikash Singh of ICICI Securities to discuss the recent downtrend in metals. 9:20, Hiren Ved of Alchemy Capital Management is a market master of the day. 9:40, we'll be speaking with the manager of Hudson Agro on the F527 outlook and the road ahead. Towards the end of the program, Lata speaks with Macquarie's Suresh Ganpati on the bank Nifty's recent underperformance. That's an interesting one coming up as well. Take a quick break here. Our list of top stocks to watch with our research team comes up next.
Welcome back. You're tuned in to Bazaar Morning Call. You're on CNBC-TV18. Well, our research team is standing by with CNBC-TV18's top stocks that you need to track for today. Let's set things off with Vinny, who's joining us to tell us about some stocks that she's tracking. Hey, Vinny. Good morning.
Hi, good morning, Nigel. So first up, we have JSW Steel. Now, the company has said that they will be developing coking coal mine in the rights for this mine in Mozambique. The project has around 850 million tons of reserves, and it has a potential yield of around 250 million tons of usable coking coal. So positive there for JSW Steel. Interglobe Aviation, that's another one we'll keep an eye out on. Now, given the crude prices have risen so much over the last couple of weeks, this accounts to around fuel cost accounts to around 40% of their overall cost as well. So now the airlines has taken a fuel surcharge starting 14th of March. The charges range from around 425 rupees for domestic flights to international flights. It can go up to around 2,300 rupees as well. Jet fuel prices, obviously, do not forget that 85% surge due to the geopolitical tensions is a major important setback that came in for the company. So at least some bit of a relief comes in on this front. So I'll expect green here. As the DM, we're expecting red here after there was a nurse strike that took place in Kerala that led to a revenue loss for the company of around 17 crores, and a possible additional loss that they would be booking would be around a 5 to 6 crores as well. So there's some bit of an impact of that. So mild red here. Zyduside, that's the last one. The company is one of its drug which is maybe mainly used for enema and patients suffering from chronic kidney diseases. It's used for the treatment of that. That has gotten an approval from China, and that opens up a new market for the company as well. It's positive news there. Green here.
All right. Thanks very much for that. Well, Gaurav is here with details on IDBI Bank. Gaurav, good morning.
Well, yes, good morning. First of all, if you look at IDBI Bank, we have seen the story that IDBI Bank is looking for a stake sale. I mean, government is looking for a stake sale. And together, Government of India and LIC, they were going to sell around 60% stake. But it seems that the plan has been cancelled. And the reason being that, as per sources, the bids that they have received are below the reserve prices and transaction may not be proceeded. As per sources, there were two bidders, prominent bidders. First is Emirates NBD and Fairfax. If you look at the structure itself, Emirates NBD recently acquired RBL. And if you look at Fairfax as well, they have they own CSB Bank already, and it looks like the bids that they have made or any player that have made have been below the reserve price, and that is the reason why in this fiscal year the divestment was expected to happen or at least get bids. It is not likely to happen. If you look at the stake that they currently have, they have around 94% stake together, Government of India and LIC, and they were going to offload around 60% stake for a value of more than 30,000 crores. And if you look at IDBI Bank as well, in the last 1 month, we have seen the bank stock has gone down almost by 17%, but it still trades at around 1.7 times price to book. So it will be really interesting to see how investors now treat IDBI Bank from here on.
Got it. All right. Thanks a lot for that. Gaurav, let's hop across to Vivek. He's here to tell us about some more stocks that are on the news. Hey, Vivek, good morning.
Good morning. Quite a few stocks in focus on the back of news flow. First on the list is GMR Airports. The company has gone ahead and won the bid. Remember, this particular bid that we're discussing is the bid that was cancelled by the Delhi International Airport from Senexi. And after an open tendering process, GMR Airports has won the bid to go ahead and upgrade Cargo Terminal 1 at Delhi Airport for 10 years. The company expects or estimates revenue contribution in the first year itself to be close to 340 crore. The company has also given an update as far as February operationals were concerned, and as expected, given the kind of geopolitical tensions we've seen, passenger growth has been muted, just 0.3% growth on a year-on-year basis. Wartech Wabag is the other company in focus. Last week, the company had announced an over 1,000 crore order win. And again, over the weekend, the company has said that the company, as part of a joint venture, has got an order from the Chennai Metropolitan Water Supply. This is to develop transmission network for Greater Chennai City. And again, this particular order is worth over 1,000 crore. Important to see what is Wabag's contribution or what Wabag will get from this particular order. A couple of other order wins. Barjal Projects, the demerged entity of Bazaar Electricals, that particular company has got a 700 crore order from Maharashtra State Electricity Transmission Commission, and this particular contract is for EPC works for power transmission line and substation works. And lastly, Data Patterns, again an order win over here. 32 Doppler weather radars is what the company is expected to provide, and this particular order is worth over 280 crores.
All right. Interesting list there, Vivek. Appreciate it. Well, what we're going to do is just quickly recap our... okay, I think we have Rima with us, and Rima has moved across to the newsroom. Rima, Reliance, I guess, is in focus.
It is, because the Finance Ministry, in a notification on 13th of March, has amended the IPO rules. And now for very large IPOs like potentially Reliance Jio, the minimum public float requirement has come down from 5 to 2.5%. So this is basically trying to accommodate larger IPOs like Reliance Jio. Remember, at the AGM, Mukesh Ambani had committed that the Reliance Jio IPO will take place in the first half of this year. So this just paves the way. It's one step forward. According to some reports, which we've not managed to verify, the draft papers for Jio IPO are likely to be filed by April of 2026. Back to you.
Got it. Thanks a lot for that, Rima. Well, here's a quick recap of all the top stocks that we're looking at. Stocks with positive news flow include Reliance Industries, JSW Steel, Interglobe Aviation, Zydus Life, GMR Airports, Patek Babag, Pagel Projects, as well as Data Patterns. While the other ones will be reacted to negative news flow. They include IDBI Bank and Aster DM as well. That's about all the equity market stocks you need to focus on. But the commodity space can't keep it out of the spotlight. Manisha joins us to tell us what's going on out there. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'll start with the crude oil prices, where we did start Asian markets at $106 a barrel. Seems to be holding around those levels as Middle East war enters its third week. And the latest from the weekend is the U.S. striking military assets on Karg Island over the weekend. Well, this is an area where 90% of Iran oil exports happen. As of now, there is no impact on or attacks on Iran oil infrastructure. But Iran says any attack on its oil infra and it will trigger a retaliatory strike on U.S.-linked energy facilities. So we are far from out of woods really onto this one. The only reason that we are not holding 106 and above is because U.S. is expected to announce a coalition of countries to escort ships through Strait of Hormuz. That is what the street is watching for at this point in time. But the strength in U.S. dollar index and the inflation coming in from the crude prices on the higher side has led to money coming out for metals. Gold, if you look at that, is trading now below $5,000 an ounce. 2 weeks of decline is what we've seen in gold and silver both. Not just that, the metals also seem to be coming off slightly. So whether it's copper off its highs, aluminum off its 4-year highs, some pressure is in the steel prices as well in the Asian markets right now. So energy on the positive, metals not so much.
Got it. All right. Thanks a lot for joining in, Manisha, and giving us all of those cues. We'll slip into a short break. On the other side, we have Rohit Srivastava of India Charts and Strike Money, who will be joining in to talk about the West Asia war, the crisis impact on Indian markets and more. Stay with us.
Welcome back. There is no need to panic as India has robust forex reserves. That's the word coming in from Piyush Goyal, Commerce Minister, on the LPG crisis from the sidelines of the CNBC-TV18's 21st edition of India Business Leader Awards. Of course, this took place over the weekend. Star-studded event. Just wanted to play out some sound bites of Minister Goyal.
We are looking at various sources of alternate sources which will feed the requirements of India. What we have only done is to increase the time between two cylinders that a person can take. And of course, there's been a short-term, it's more a supply-demand time issue. It's not an issue of finally the availability as much as the timing to be able to give enough shipping time for these gas sources to reach India. And therefore, I see no reason to panic. I wish people would understand that we are in a war situation. They should not hoard gas cylinders.
All right, Rohit Srivastava is now joining us. He's, of course, been with us over the last, 15 days or so as this has played out. He's founder of India Charts and Strike Money. And for those of you who are not familiar with Rohit's views, he's been negative for a while. Way before the Iran conflict started. And of course, I mean, what's happened with Iran is has accelerated how his view has played out. Rohit, good to have you back on the program. So we are near 23,000 on the Nifty. We are near a swing low on the Nifty Bank, which is the September 2025 level. The question is are we pricing in a lot, or you think there is a lot more to go?
So yeah, good morning, Prashant. And I think when I started out, I was essentially studying macro factors also along with the breakdown in Nifty, which takes us to the dollar, etc. But before I go there, I'll just mention the Nifty is trading below the 20-month average, and it's pretty much broken that, although the month is not closed. So that was at 24,000 700 odd. And the next major support, which is near the 40-month, and the lower bands, which are closer to around 22,500, 22,600. That is what we'll be looking at as the next major support. So that's around 400-500 points lower than here. On some key indicators like RSI, it may look like the market is oversold. We do see even the FIA positioning having reached an extreme. But we haven't studied FIA positioning, in a severe, bear market. The previous occasions was probably when we didn't have data, which is like 2008 and 2020 in COVID, when it reached an extreme. There was a ban on further shorts, and then we recovered from there. So this has been directional. FIs have continued to hold shorts, but we look at that as a contrary signal. Sometimes I'm not sure whether we should right now or not. But yeah, we have one or two indicators that are reaching a extreme, but there are many others which are not yet there, like the put-call ratio is still not reached the oversold zone. And so what we are trying to do is simply wait it out and let it, base out before we really say that, we are getting to a bottom. But there's still downside risk. We can't completely rule that out. And which then takes us, to other factors that are impacting the market apart from, just the domestic data.
All right. Hi, Rohit. Good morning and good to see you. So the RSI has moved closer to extreme levels. PCR, I think, at around 0.75. It still has some distance to go. And the short positioning at around 2.6 lakh contracts. They are as well as getting a little bit extreme. Rohit, congratulations, first of all, on that call. You became cautious long before a lot of traders we heard. So good call on that. Now, the question is, what about the Nifty Bank? Because when the markets moved up, that was holding strong. Then last week, after a while, actually, the Nifty Bank underperformed the Nifty. And if the markets need to either rebound or move down from here, that's going to play a big role. So what are the levels you're looking at on the Nifty Bank?
Yeah, so I'll put out the similar levels. And you're right. In fact, it's not just Bank Nifty, but various other sectors that are slowly starting to participate in this, free fall or falling knife, as we call it. And that's where it's getting broad-based. So the 20-month average for the Bank Nifty, that's 54,580. Here also, we are trading below it at 53,757. So probably, around almost 800 points below that. And the next support after that, which comes in at 50,258, so that, opens room for another 2,000-3,000 points down for Bank Nifty, which is a lot more. So the pressure is actually building on, sectors outside of the Nifty, which will then, of course, impact it as well. Which have just started to participate on the sell.
What is the support on the Nifty Bank? I just missed that number.
Yeah, so the next one is 50,258.
Sorry, Rohit, the one before that, there is one.
Okay, the 21, that's 54,581. That's that's the 20-month, and we are just trading below that.
Below that,
yeah.
Yes.
So you're saying 54,581 and then 50,258. These are large gaps, right? In that sense, between where we are and
because the Nifty is already gotten there, and the Bank Nifty is just starting, so it has more room. And if we slowly shift towards the next index, which just sold off on Friday, like the metals, you'll probably see there's a lot more room happening there. So we are seeing this shift, happening from sector to sector. Those which were holding out, giving up one at a time. I think pharma is still holding out, so that's still an area of strength, probably where the defensive money really goes to. And we are seeing this even globally. So if you actually study US versus Europe, US versus Asia and emerging markets, they were all holding out till, most of February, even most of March. You didn't see the sell-off in Japan start only till, maybe a week or two ago. So same with Europe, so they were, like UK was making all-time highs just, till 5-10 days ago. It was just ignoring all the bad news. So we are seeing other markets start recognizing that this is becoming a more prolonged affair, and I think that's where the reactions are really coming from.
Yeah, Rohit, just a quick word on oil. I know it's a wild one, right? It'll all depend on actual demand supply and what happens to supply. But would you imagine that last Monday, same time last week, oil hit 120. And then as soon as we hit 120, voices started coming in, and US officials started saying that maybe this is going to be short-lived and it's going to end quickly. And if you remember, and oil cooled off. So there is this reflexivity to markets, right? As they say, markets decide outcomes.
Yeah.
Would you say 120 perhaps for now is a kind of a soft peak?
So we made a high of, around 124, 125, I think, when on WTI I'm talking. And of course, Brent would have been higher in the 30s, maybe 135. So that was the high we made when the Russia-Ukraine conflict took out. So technically, we would say that that is the peak level, that we don't really cross 130 in general. 120 that we touched is not very, very far away from that. So it's most probable that prices remain contained within this 100 to 130 range based on how the news flow really plays out. Sorry. I think the bigger concern, more than oil, is going to be the dollar itself. We may say that the dollar is going up because of one reason, and it might find another reason tomorrow. It could be bond yields. We can say bond yields are rising because of higher oil prices, but it could also be due to a prolonged war and the cost of the war itself. So there are different reasons that can cause bond yields and the dollar to remain elevated. So I think that will be a bigger risk to liquidity really flowing into emerging markets, Asia, commodities, etc., than oil itself. Oil could somewhere just remain elevated here. We may not see a significant new highs, like I said, contained within 130 to 100 range based on just near-term news flows.
Rohit, 130 is 20% higher from here. Markets will get slammed if we see those sort of levels, but hopefully we don't have to see that. Finally, just looking at a few outperforming sectors just for the month of March in this fall, the tech index that actually cracked very, very badly. Off late it's been outperforming because it made a low, I think, at the end of February of around 29,800 odd. It's currently at around the 29,000 odd mark. Does that have support, or is that bracing for a bigger fall? Because year to date it's down 25%.
I think, the IT sector has more legroom down. My own target for the Nifty IT index initially is at least towards 26,840. So that's still around 3,000 points lower than where we are. You're also seeing that in global software stocks. I think after a brief bounce last 2 days, they've actually started selling off again. So I think the pressure is still there on IT. So if you're looking for defense, it's got to be somewhere else. I mentioned pharma some time back. That is one place where you will find defense against the market. You are seeing stocks like Sun Pharma, for example, holding out against the market. So look for that. There are a couple of others. In fact, yesterday, I was taking a session on using our momentum indicators, and we found Aurobindo, which is another pharma stock, was the only one which was giving a weekly bullish crossover. So it is the pharma. I think that is where there are a couple of defensive ideas. The second one could be as an alternate to oil, as oil is under pressure. You're going to look for energy alternates. So there could be two things. One is renewable energy, and the second is ethanol. In India, we focused on that as a alternate source with oil, and I think ethanol producers could come into demand. But of course, that's as and when market stabilizes, you'll find more buying there. Otherwise, every day we see selling in most of these counters. But they're not falling. That's the good news.
Rohit, just 2 quick points, right? This trend line from the lows of COVID, which has been broken.
Yeah.
Is that significant?
I do think so. It's a first warning that maybe the entire rally that we saw from COVID is complete, and we are doing what we call as a retracement of that entire move. Okay, we take it one step at a time, but that is the first indication. The second indication is the 40-month average, which we spoke about, which is at 22,600. So breaking that and the trend line, if both happen, then it would indicate that we are in a much more serious bearish territory, which can then be time consuming, 6 months, 12 months. So that's what we will be looking at. The trend line break is the first indication of such a possibility.
And you had said that I think earlier the call was to buy 26,000 puts. Then it became 25,000 put the last time we spoke.
Yeah.
As protection, December 20. So I mean, those of course would have done very, very well. But you recommended them as hedges, not as a trade in that sense, right?
Yes, I've told everyone not to get out because most investors they're not used to this, and they get fidgety. Every day I get asked, should we book out now? We are making gains. The 400, 500, 600 price has become 1400. My answer is, don't look for a particular level. People obsess with, is the bottom going to be at 22, 21, 19? I'm like, it's not about a level, but do we price in the risk in terms of India VIX or the volatility index? So the volatility index has two key levels. One is close to around 24, 25, which we've seen during the India-Pak war, the Israel attacks, even the Adani fiasco when it happened more than a year ago with the yen carry trade. But there are a couple of times we went to 30, 35, and that is, I think, more relevant. We got there, I think, even when the Russia-Ukraine attacks happened. I think that's a level where we would get, maximum panic. So while markets are down, the India VIX doesn't reflect that people have, reached an extreme in terms of panic. And that is when we would take a call as to, whether we should book those hedges.
Yeah. Thank you very much. Good chat as always, Rohit. Thank you for joining us and running us through that picture. I mean, I think sets us up just in terms of frame of mind to think about things from here as we kick off and get into this new week. We'll take a break here. We'll come back and we'll turn our focus and attention to the auto sector. Jay Kale will be with us with a spotlight on the auto space and, road ahead there. Stay tuned. Coming up. Welcome back. I think there is a flash at the bottom of the screen. US arm of Glenmark Pharma is going to launch potassium phosphates injection in multiple vial sizes. We'll try and get a sense of what's the size and is it large, meaningful, etc. for Glenmark in just a bit. But Jay Kale is with us on the program now. Jay, good morning. Good to have you with us here. Thanks for joining us. Across your portfolio, across your coverage universe, beg your pardon, I'm assuming the direct implication from a straightforward perspective is CNG and then, of course, production disruptions, etc. for auto OEMs. So just kick us off with regards to how you're thinking about the implication for the auto space because of the Iran war, price hike as far as energy is concerned, and some disruption to gas supplies.
Yeah. Good morning. Yes, and if you see, up until Jan, Feb, and we had seen demand holding up quite well, and it was quite a pleasant surprise for autos that despite post-festive, where demand was expected to moderate, things were holding up quite well. And then you had this, Iran war coming up. Now that puts a lot of uncertainty in the short term. Multiple factors there, as you mentioned. One is the production disruption that is likely to come in the coming weeks if the gas issue persists. Second is one needs to see where crude settles and what that would have an impact on the end diesel prices and petrol prices, and hence the cost of ownership and the sentimental impact from a consumer demand perspective. And third, of course, is the rising commodity prices, which can put pressure on the margins of most of the OEMs. And depending on which sector you are and where the demand is holding up, the ability of the OEMs to pass on these prices to the consumers will kind of decide which companies see the least earnings cuts in that perspective. So what started off as a welcome surprise in the auto sector has hit a speed bump in the new calendar year. It's still evolving and one needs to keep a close watch on the production disruption in the coming weeks.
Would you want to
As of now, we are not seeing much of a disruption.
Yeah.
But if the situation persists, there could be likely production disruption.
Yeah. Yeah. Who's most at risk in your coverage universe, Jay?
No, I think, from a production disruption perspective, it's you can't pinpoint any one specific company, even a small supplier in the value chain. If it gets impacted, the entire supply chain gets choked. So it all depends on, of course, all the OEMs will be firefighting right now to get their production supplies, secured. But it's the risk is across the board. All OEMs are at risk. because even if one supplier gets disrupted, it affects the value chain.
Yeah. In a way, Jay, it's actually the weakest link in the supply chain, right? Which will decide the outcome of this. Am I wrong?
No, absolutely. I think even a small supplier, tier 2, tier 3 supplier, or say a casting supplier, doesn't get the required amount of gas or a pipe natural gas, then the entire value chain, and you can't have a auto or a vehicle rolled out of the production line without even one part. So it's really sensitive to the weakest link in the value chain. And but that apart, we have seen these disruptions historically. Stocks have corrected. Of course, that gives some bit of an opportunity to value pick. We had seen some bit of these disruptions during the Russia-Ukraine war also, not so much from a production standpoint, but from a commodity and crude oil price standpoint. And things had recovered decently well. But one needs to see how long this persists for the extent of pain that we can see in the stock prices.
Since there's so much weakness, Jay, would there be a couple of companies that are on your radar that you would be actually optimistic on and you would advise adding positions on the long side?
Yeah, so I think we feel companies which are structurally in a positive space from a market share gains perspective and ability to pass on the raw material cost to the consumers. We see value picks in two-wheeler space where something like an Eicher and TVS have sustained their market share gains over the years, and their pricing power also would be relatively better. So in two-wheelers, we prefer Eicher and TVS, and passenger vehicles, there is now value being sought for Mahindra and Maruti. While passenger vehicles, if you see during the Russia-Ukraine war, were a little slower than two-wheelers to pass on the raw material cost to the customers. But I think what is heartening till now, at least that the demand is holding up well as of now. So we would really want these disruptions to kind of ease off. And I think these four names would be our top picks.
Okay, all right. Got it, Jay. Appreciate you joining in and giving us your quick take on the sector, as well as a couple of stocks that you believe are relatively better placed. Well, I think for the time being, we could maybe slip into a short break. Okay, all right. I think we have Hormuz actually. Before we take that break, let's go across to Hormuz. He's joining in to tell us about all those stocks that are moving around on Friday's trading session on large volumes, and some of them backed with delivery. Hey, Hormuz, good morning.
Morning, Nigel. Welcome back to you after your break as well. And the list today, of course, is a couple of stocks that were bucking the trend in an otherwise market that was having a bit of a meltdown on Friday. One of them was LTTS, L&T Technologies. The stock was up 10% in that kind of a market on Friday. The biggest single-day gain that the stock had since March of 2020. Volumes were the highest since July of 2021. It had more than 35 lakh shares that were traded on the stock. The 20-day average is only 1.5 lakh. And among those shares traded, only 6% of those were marked for delivery. That is only close to 3 lakh shares. Even here too, the 20-day average is only 25,000 shares. And in fact, the stock made a 52-week low on Friday intraday of 3,010 and then recovered from those levels to surge over 10%. The big underperformer on Friday was CEAT, and the stock was down 9% on Friday. It snapped a 3-day gaining streak. That before Friday's fall, the stock was up 15% in the 3 previous sessions. The Friday's volumes during when the stock fell were less than Thursday, when the stock was up almost 7 to 8%. It was 4 lakh shares were traded. The 20-day average is 1.5 lakh. The percentage of delivery volumes as well in comparison to the total number of shares traded was also the lowest in the last 2 months. Only 83,000 shares were traded, marked for delivery, 20-day average of around 53,000. The important level now for CEAT is 3,400. And why is that so? Because it has not closed below that level for 2 consecutive days, going all the way back to September of last year. And the other one that bucked the trend on Friday was Syngene, as one of those 44 names on the Nifty 500 that ended higher. But in the previous 13 trading sessions, the stock had gained only twice. Now, that's the kind of underperformance you had seen on the stock. The Friday's volumes were the highest in almost a year. Close to 1 crore shares were traded, 20-day average of 10 lakh shares. Almost a quarter of those were marked for delivery, around about 27 lakh shares. Here too, the 20 20-day average is around 5 lakh. And this one too had a decline to a 52-week low on the 9th of March and saw that bit of a rebound on Friday's trading session.
All right, Hormus, thanks very much for that. That's an interesting list of stocks with regards to price action, volumes, etc. on Friday. We take a break. We're back with the pre-open session. Vikash Singh of ICICI Securities will talk about, that 5% sell-off that we saw in the metals index last week. Again, the big story is the disruption of in terms of gas supplies and whether it is starting to hurt. We'll also connect with Sudarshan Sukhani and Mitesh Thakur for some technical trading ideas coming up.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. And the markets are indicating a more or less flattish start. Remember, last week was to the bears because we saw a sharp correction of around 5% apiece on the Nifty, the Sensex, and the Nifty Bank pulling back close to around 7%. In fact, it could be a mildly positive start, but will that start be used as a shorting opportunity? Sudarshan Sukhani as well as Mitesh Thakur are back with us. Hi, good morning, gentlemen. Good to speak to you all after a while. Well, Mitesh, you go first. A very sharp pullback. The bulls will argue that we can't keep falling 300-400 points every day. That's at least what we have seen in the last 3 trading sessions. Do you think there's a case for a relief rally, or do you think just hold on to your short positions and ride it on the downside?
Morning, Nigel. We've been getting all those memes about the number of days of petrol and LPG cylinder has been stopped. And I think one of them was on Nifty as well, that we are falling by 300 days and we have got only 76 or 77 days of stock left. So, yeah, it can't keep falling every day. One. Two, I think, it's come to a very important level. If you look at the Nifty chart, on the 11th, between the 11th and the 15th of April 2025, there was a big gap around this 22,900 odd levels to about 23,100, 23,200 levels. So I think we are right there in that gap area. We are extremely oversold. Similarly, for the Bank Nifty, look at the historical chart, and sometime in September of 25, you will see a cluster of lows and bottoms being recorded around the 53,600 mark. Same on the 9th of May 25, same level was the low. And before that, in December 24, at least on 5 or 6 occasions, there were intraday highs made around this 53,600 mark. So on both the indices, we are at critical or important historical support levels. On both the indices, we are extremely oversold. Looking at that overall picture, while the bigger trend is still negative and still weak, I think in the short term, you might be close to forming a bottom. And therefore, I think I said on Friday as well, that time to take profits off the table, at least on the short side, if you have, and around 60-65% or 2/3 of your position should be booked. So I think these are good levels to take profits. We might not go aggressively long because the broader direction is still on the downside, but once you get a pullback, and we are also very far away from the 10-20 day averages. Once you get a pullback, then I think I'll look at getting into fresh short positions.
Got that. Mitesh, in terms of your specific trades, what would those be?
Prashant, I have a mix of buys and sells. On the buying side is Aurobindo Pharma. It was a buy last week as well. Now I think, can be bought afresh with a stop at 1278. Targets of 1335 is what I recommend. Coal India is a buy with a stop at 459 for short-term targets of around 485. A sell on PG Electropast, it's broken a rising trend line. So sell on a mild pullback, say around 5-6 rupees higher from here, around 507, 509. Sell with a stop at 522 for targets of 480, and also a sell on Container Corporation of India with a stop at 462.5 for targets of 435.
Okay, well, some buys are emerging, some sells as well. Sudarshan, good morning. Good to have you with us here. I mean, it's been tough. Last week, of course, 5 and 7% gone on Nifty and Nifty Bank respectively. Where are we at? And top down, let's start there first.
Yeah, good morning. See, the trend is down. There's nothing to suggest that the trend has changed. Earlier, I had suggested somewhere around 23,000 could be a possible stop point. We are almost there. So short positions should be closed. This doesn't mean that the downtrend has come to an end. It simply means this is wise risk management. Now, for the short term, for today, it is also possible we can look at a buying opportunity if the Nifty holds on to 23,150, which is Friday's close. So it's not a very big deal. It's just if the Friday's close is holding, say around half an hour, 1 hour after trading, that's a buy. That tells us that at least for the time being, the shorts have said, okay, we'll step aside. Buy then with a very tight 100-point stop. If the level has broken by the next 30 minutes or 45 minutes, nothing to do, step aside.
Okay, got it. And individual stocks? Sudarshan, you want to give us some views?
Yeah, Oro Pharma is a buy for me also with a stop under 1270. Marico is a buy with a stop under 745. BEL is an intraday short. The word here is intraday with a stop above 445. And Vedant is also an intraday short with a stop above 700. The reason I'm not suggesting carrying short positions is the markets may be willing to find a low somewhere around this level. So there's no need to take unnecessary risk.
Okay, all right. Thanks a lot for joining in, gentlemen. We'll come back to you all. For the time being, let's address the index that sold off actually on Friday's trading session, which was the metal index. We have Vikas Singh, Vice President at ICICI Securities, who joins in. Hi, Vikas. Good morning. Good to see you in. Vikas, what happened on Friday? Was it routine profit taking? Did something change with regard to the metal stock selling off? And also a quick word with regard to this, the facility in the Middle East that has announced a partial shutdown. I think it was part of the earlier force majeure that they had announced, right?
Yeah, good morning, Nigel. Thank you for having me on the show. So firstly on Alba, basically Alba has already declared a force majeure when the war started, but they have not stopped the production. So Bahrain has a 1.6 million ton of annual capacity, and out of that, roughly about 19 to 20% of the capacity, they've started partial shutdown because they imports alumina and like aluminium exports is getting difficult, alumina imports is also getting difficult. So they're just trying to prolong the rest of the capacities because once you close the aluminium smelter, it takes a fairly long time and money to get it back online.
All right, aluminium Bahrain, that's what Alba is what Vikas is referring to. So Vikas, in terms of aluminium prices that have held very, very strong, in your estimates, what are you working with with regard to the numbers? And currently, the price is quite elevated. So what is the difference between the two, both on aluminium as well as on ferrous?
So as I mentioned in the last week, our conversation, we are still maintaining a long-term average of 29.50 in our estimates for FY28. But in a short term, we expected it to go to $3,500, which we still maintain.
So then that will be good news for the aluminium players. Nalco has been a stock that's actually done quite well, but I think you are more comfortable with Vedanta. Could you tell us, among the aluminium players, what is your preference as of now, just to revise? Because as you're saying, your estimates are working with a sub $3,000 number, while we're currently closer to around 3,400 odd.
Yeah, so in current scenario, Nalco is slightly better benefiting from the overall aluminium prices because of the mix. Vedanta has also the copper, steel, and zinc as well. And silver also was a big segment which is going down. So relatively, Vedanta is less overall beneficiary, but we have our top pick Vedanta as of now at this point of time.
Okay, tell us a little bit about this Middle East crisis. And one of the stocks to focus on is being APL Apollo. I recall in the last quarter, actually, it appeared things were turning around for them, both on the volumes, on the profitability. And that big boy actually has stood tall because you had a smaller players that were trying to creep in there, but they have held on to their market share. However, they have exposure to the Middle East and also they have some gas dependence. So quantify the hit for a company like APL Apollo, and would you be a buyer post this recent sharp correction?
So domestically, they use gas for their galvanized production, which is a zinc bath to maintain that temperature. Roughly about 20% of the production comes from galvanized. We don't expect the entire 20% to get shaved off. So assuming 20 or 30% gas reduction, you usually get that percentage, 5 to 6% might get impacted. Also, Dubai basically 7 to 8% in total EBITDA. There, what we understand that the production is not fully closed, but yes, the demand might get into a little bit of situation, basically. The demand might not be that great since the war is going on. We will still wait before initiating any fresh buying call to our clients for APL Apollo.
So it's a double whammy for them. One is on the galvanized side of it, which is 20% of their mix. Some part of scale back over there because of the unavailability of gas. And the Middle East as well, though it's functioning, it may not be functioning at optimal levels. So some pullback out there. But for the time being, you're maintaining a cautious stance. Got that. The other big announcement last week was the Jal Jeevan mission, right? It got a green signal. And there could be a few beneficiaries. You want to name the biggest beneficiary from the list?
So the DI pipe players are supposed to get more benefit than the rest of the pipe players, followed by HSAW pipe players. So the DI pipe players are, the biggest one is Electro Steel Casting, Rashmi, which is not listed, and Jindal SAW. Basically, these guys were supposed to benefit more in this scenario. Jindal SAW also has HSAW capacities as well, so they get benefit slightly better than others.
Got it. Okay, all right. And finally, Coal India, I know you don't have official coverage or it's in your restricted list, but, that one has outperformed. The hope is that now they'll get pricing back and they'll get volume offtake as well, both of which has been missing for the last 12 to around 18 months. Have you seen any signs on ground that e-auction prices have moved up marginally in comparison to, say, the Q3 average?
Would be slightly early to talk about e-auction prices movement, but if you just compare with 2022 crisis when the energy prices went up, including the coal, e-auction prices did went up, but not to that extent which the international prices have gone up. So our expectation is that the e-auction prices would go up, but relatively in lesser quantity. Plus, you need to mind the fact that versus 2022 and now, many of the private players also have their own thermal coal mine. So that would cushion the full impact.
Vikash, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV18. I think we're at 9:10, which is 5 minutes to go for market open. The Nifty pre-open has ended, and we are, it'll come up on your screen, 35 points lower, so 23,100, around where we left off on Friday. A 9:10 call. Sudarshan, what do you have?
It's Oro Pharma. Buy Oro Pharma with a stop under 1270.
Okay, Mitesh also had Oro in his list earlier. Mitesh, what about you? 9:10 call?
I think the pharma pack is doing really well, so that's going good. But I'll go with the sell on Concord.
Okay, sell on Container Corporation. So that is the 9:10 calls. More later. Now, let's talk about a couple of other names, right? L&T sold off hard on Friday. And Vivek is here with this one in focus. Vivek, tell us.
Well, that's right. L&T Friday down over 7%, over 20% correction since the West Asia crisis has unfolded. So today, a couple of very interesting notes have come about, a bull case and bear case, if you could call it that. First on the list is what CLSA is saying as far as L&T is concerned. They've gone ahead and analyzed L&T's number one West Asia customer, which is Saudi Aramco, and they've said that despite the fact that Saudi has guided for a flat capex in 2026, it augurs quite well for L&T, given the fact that there were expectations that there could be cuts on account of the ongoing conflict. Also, CLSA says that the recent 23% correction is an added opportunity to accumulate India's key as well as one of the global key energy capex plays. On the other hand, quite a few bear cases as well. Access Capital, in fact, has done an interesting analysis. They're saying that the entire fall has to be seen in the context and in the backdrop of the ongoing conflict in West Asia. What they're saying is that execution in West Asia has been materially impacted by disruption to movement of men, material, as well as construction equipment. So they've gone ahead and they tried to quantify the entire impact. They're saying they're expecting close to 1,200 crore of impact to EBITDA in Q4. So almost 7% of the FY26 EBITDA estimate would be impacted. Now, what they're saying is that in case there is an extension to the war beyond March, they're saying that there is a possibility of a further 18% correction as far as L&T is concerned. And Nuvama in 2 has done, they say that downside from current levels is limited as far as L&T is concerned. They're saying that the SOTP bear case target itself works out to close to 4,000 rupees. And they're saying L&T currently is trading near its historically low valuation multiples. They're saying not much downside left despite all of the worries that are being priced into the stock currently.
Okay, all right. That's L&T for you. 20%, by the way. Down actually just this month, and I think 20% from the highs as well. Let's talk about the other set which is in focus. That is oil marketing companies. And Sud is here. He's passed through some brokerage notes on this sector. So take it away.
So HSBC has come out with a note and has downgraded all the three oil marketing companies, HPCL, BPCL and IOC. And it's on the back of sharp increase in the crude prices we have seen. In the last month, the average crude price for the Brent was around between $65 to $70 per barrel. Now, which has moved higher, it's above $100 per barrel for the last few days. And because of the HSBC believes that there would be a sharp cut in the earnings as well as the multiples. And even if there is a recovery in the crude and Brent goes back to $75 per BBL, despite that, there would be losses on the marketing front. So for IOC, it has downgraded to hold, target cut to 150 from rupees 200. For HPCL, downgrade to hold and target price is cut to 360 from 620. And for BPCL, it's downgraded to hold and target price is cut to 340 from the earlier price of rupees 470.
Okay, all right. So thank you very much for that. That is oil marketing company. So L&T is an upgrade, and I mean actually at least a constructive view, and OMCs is a downgrade. But stocks have already corrected a fair bit, right? Now, a quick recap of all the other names as well, which we've highlighted from the morning. Reliance Industries should come up. Flat. JSW Steel is up about 0.25%. Interglobe Aviation is down about 1 1/4. That's about 4,100 now on Interglobe. There is Zydus Life, GMR Airports, VA-Tech, Webag, etc., which are also coming up with starts. You got Data Patterns, Bajal Products, which is up about 7%. IDBI Bank is another one, down 11%. Boy, that's a big one. And there is Aster DM, which is starting slightly lower. We've got the first rates coming up anytime now, and then we will sort of read those out and then go on and look at the broader space, as always. What do we have? The Nifty and other large indices are starting flat to slightly lower, maybe in the green. Yeah, in the green. 23,200, 1/3% higher. So there is a bit of a bounce afoot. Let's hope it lasts. Nifty Bank is, yeah, it's also starting about 1/3% higher. So, I mean, actually quite damaging falls last week. And now there is some green. Nifty mid-cap index is flat to slightly lower, and actually sideways, nothing at all. It's blinking red and green. The Nifty small-cap index will come up as well, and that'll give you a sense of where we are. So 40, 50 points lower on the Nifty small-cap index. 640 higher and about 1,000, 1,100 stocks which are lower on the NSE 500 list. So that's the overall picture. But let's dive into individual names and the broader market. Nigel.
Well, that's right. You know, a few stocks actually, Prashant, deserve special attention. IDBI Bank, the government might not proceed with the divestment as bids likely to be below the reserve price. CNBC-TV18 had given you a bit of a heads up on that one. IDBI Bank is the one that's taking it on the chin. Big downtick is what we're seeing on that particular name. So that one's losing out. Vartech, they're backed an order of around 1,000 crores to build Chennai's looped water grid. So that one, in fact, I think has opened up well in the green, up close to around 3% or thereabouts. Adani Power as well, there was some favorable news that did come in there. And the stock is clearly reacting to that. So that stock has opened up with a gain of close to around 4% or thereabouts, 3% now. The other stocks that are doing pretty well, Tejas Networks, the stock did see a bit of a pullback from the recent top. So today it's moving up on high volumes. Tejas Networks, I think HFCL, as well as Sterlite Technologies, all of them doing pretty well in today's trading session. What else? On the upside, Bagel projects, because of the order win, the stock is up close to around 10% or thereabouts. Ramki Infra as well, up close to around 5%. There's an order win even on that particular name. On the flip side, from the broader markets, a few stocks are getting clonked. IDBI Bank now down 12%. HPL Electric, that's down close to around 6.5%. So big downtick is what we're seeing on that one. And Chennai Petro as well. The refining margins have moved up. The stock has been all over the place, fluctuating big time. For the time being, that one's lost close to around 5% as we speak. And TTK Prestige as well, after the recent run, has come in for some profit taking. As we do that market check, the markets are as flat as can be. The Nifty Bank as well flattened out. The mid-cap index continues to see pressure. One stock advancing for two stocks that are declining.
Absolutely. And, just if you look at what's doing well, apart from outside of what we've already discussed, Zydus Wellness is up 4%, and it's got some volumes on it within the top 5 volume-led gainers on the NSE. I think VA-Tech Webag, we mentioned earlier, that is about 4% higher. Keynes is starting about 1% in the green. Again, I mean, a name which is actually corrected quite sharply over the last few. Actually, it's not recent. From the highs, it's come off from 4,100 or so was the highs, about 600 rupees lower. But of course, I mean, from the top, it's lost a lot. Ultratech is higher. Thermax is up about 3% or so. GMR Airport is up about 1%. Aeroflex is another one which is coming up with about a 3% pop. That is Aeroflex Industries. But it's 1,800 lower and about 600 higher. So it's clean 3:1, declines to advances ratio at this point. Lots of silver. I'm not sure if silver has seen a bit of a down leg right now, but silver, the ETFs are all down. Anything between 2, 3, 4%. And that is populating the losers list as well. IT is a big one, right? I mean, LTTS is down 4%, and that is a large cut which is coming through at this stage. Happiest Minds is the other one. We had, by the way, the management with us, I think this was last Thursday or Friday, and that is down about 4% as well. The recent high was about 450. Stocks back at about 370, 380 at this point in time. 20 points, so 23,100. And 70 or so is where we are trading. Hiren Ved is with us, Director and CIO at Alchemy Capital Management. He's with us here on our studios. Hiren, good to have you with us here. Thanks for joining us.
Thank you.
So how do you assess the situation, Hiren, with all the damage that we've seen so far? And near to medium term, what's the view?
I think, obviously, whenever geopolitics impacts energy prices, I think India... It's always a problem because we still import a large part of our energy, right? But as we have seen even during the Russia-Ukraine war, oil prices spiked and then things settled down, right? So I think that eventually in the medium to long term, I think the only heart we can take is that we are aligned with the US in some sense, because I don't think even Trump wants higher energy prices, right? But I think right now we are in a little bit of a bind where none of them can afford to quit midway. And therefore, we just have to wait it out and see how things, move on from here. Hopefully, we've seen peak oil prices. Typically we see a peak price and then it hasn't gone beyond 120. If it goes beyond 120 or approaches that, I think we would, that would be a little bit of a challenge. But if not that, I think the markets more or less have absorbed peak oil prices.
Would you, and this is a slightly near-term question, and no one knows when this will end, but let's say if it ends tomorrow. Tomorrow morning we wake up and overnight there is some de-escalation that's happened. You think there is a chance that and by the way, since the war started, the Nifty has lost about 9% from that level, 26th or 27th of February. You think the market kind of, goes back pretty quickly? The rebound is going to be sharp, quick, or it's maybe you get a bit of a tactical bounce and then you'll see. What's your sense?
I think you will get a bounce, probably. And I think more than anything else, at least in the near term, the oil price will be a barometer, right? So if oil comes back down to kind of 80, 85 levels, then I think we are fine. I still believe that we can't go down to 60 because there'll be some premium which will be built into oil prices, at least in the near term. But I think if oil starts to fall back below 85, I think then we are okay.
And at current reckoning, the Nifty has corrected this 9% odd. We have factored in more or less crude oil prices around the $120 per barrel mark. That's what
typically happens, right? Whenever we have a big risk event, the market tends to discount the worst initially, and then it settles down somewhere there. Unless obviously, things escalate far beyond anybody's comprehension, then we don't know, right? Then all bets are off. But I think my sense is that we have probably seen the peak risk priced into the market.
All right. Hiren, over the last few days, you speak to market people, you speak to a lot of retail audiences. Well, there are two schools of thought, right? One go with history, what it suggests, that war cries are the buy cries. You buy and you've made some money. The other point is that at times, equities as an asset class itself, gets ignored for a couple of years. What do you think the current scenario is throwing up right now? Because the SIP money has been coming in, domestic investors have showed a lot of maturity, But now things are getting a little bit tricky because the headline index is down 12%, portfolios are around 20, 30, 40%.
Correct. So I think historically, we all look at history and all the past events, and we've seen so many WhatsApps moving around and, saying that the average fall has been so and so. But people forget that each event creates its own history, right? Yeah. So this event will also create its own history, whether finally we are 9% down or 12% down or 15% down, or we've already seen the worst. We don't know, right? But yes, I think that at least what I've seen in many years is that whenever markets are too focused on a single variable, which is oil prices today, that correlation never lasts for too long, right? Because markets are far more complex. A lot of things impact markets, but there are times when people only look at one variable, right? There used to be a time when if the rupee opened lower, the markets would open lower, right? And now people forget that correlation. Now it's oil, maybe tomorrow it's something else. So I take heart from the fact that today there is a lot of risk premium that has been built into the way markets are behaving. I certainly feel that this is an opportunity, and specifically because we've seen at least 18 to 20 months of sideways movement, right? And I think valuations are now fairly okay. Having said that, I think that people have forgotten what sideways markets are, right? I remember that, post the Harshad Mehta crash, and I know this is like several decades back, but between 92 and 98 and early 99, markets went nowhere for 6 good years, right? We haven't seen that kind of a lull, 2 years and we are already crying.
The more recent one herein is, I think, 2010 to 2014, right?
Correct.
2010,
Correct.
We hit 6,350 on the Nifty, which was the high, and then 4 years later, we were there, nothing, absolutely, right? So
Correct.
I think, absolutely right. That was, of course, a longer period, but this was equally long.
I think it was 2008 to 2023, to 6,300 on the Nifty, and then September 2013, when Mr. Modi was BJP's face, I think that's when we went back to 6,300. So that was around
I think it is 2010, Nigel. 6,350, and then
correct, absolutely.
And then
so initially it was 6 years, then it was 4-5 years. So we've seen those kind of periods where markets have gone nowhere, right? And I'm not saying it'll happen, but I'm saying that these things do happen in markets, right? So we just have to be cognizant of the fact, and I think that's why people say that equities is for the long run, but we tend to forget all of that.
So what are you doing in your portfolio, Hiren? So have people, and just give us a sense of what other HNIs are doing. Have they sold what needed to be, even stuff that you like and you normally hold, but because the environment is soured and you don't want to stand against what you don't know, right? So all that has already happened, right? Has happened some time ago.
Yeah,
so the market's light.
Markets are very swift, right? So I think most of the stuff gets discounted very quickly, and then somewhere down the line, sense prevails, right? But we had a little bit of cash, and we have been deploying these last few days. We don't know where the bottom is, but I genuinely believe that if I were to look 6 to 12 months out, I think we would be significantly higher, from where we are today, hopefully. You never know, because these days you have disruptions happening very quickly, one after the other. But I think that we've spent a lot of time. And I'll give you, I was just looking at some data yesterday that when we ended March 2020, just before COVID, right, the top 500 companies' aggregate profit after tax was 4 trillion rupees. Today, in this financial year, our quarterly run rate is 4 trillion, right? So we've gone from 4 to 16 trillion of absolute profits. And the peak of just before COVID happened, I think peak Nifty was 12,200, if I'm not mistaken. From 12,200, you are even less than double today, right? While profits have actually gone up significantly higher. So I think even from a valuation, aggregate valuation perspective, I think we are at fairly attractive levels. Now, what happens in the next 1 week, 2 weeks, 1 month, I don't know. But I think if we are long-term investors, to me, this is a great opportunity to buy.
3 ideas, Hiren. Leave us with 3. I mean, things to chew on, things to...
no, I think...
maybe research a little bit more. I mean,
look,
what would make your watch list?
Okay,
yes.
let me put it this way. I think that typically the the thinking is that let's hide into something which is not impacted by what is happening in the near term.
Yeah.
Right. My sense is that one should do slightly the opposite.
Yeah.
Right. You buy the stuff that is significantly impacted by what is happening, because there is already that risk premium that has been built into those stock prices.
Yeah.
So when things normalize, you not only capture that and the normal return, right? Yeah. So my sense is that today, again, I can't say individual names, but I think broadly speaking, I think small and mid caps have corrected substantially. There will be some areas where stocks are available 30-40% cheaper.
So you would allocate more to small and mid caps rather than the headline names, right?
I would.
Okay, all right. I want to ask you about a couple of companies, and you could, pick and choose between them. One has been a big winner, which has been Force Motors. It's been a multi-bagger for you all. From the recent peak, I think it's corrected close to 20%. And by the way, I was in Uttarakhand for the last week, and I was surprised to see so many Urbanias even over there. And the other one I want to ask you about is Bajaj Finance. I think you track that one closely as well.
Yeah.
Lot of focus with regard to the AI adoption, and it's a quality name.
Yeah.
That's pulled back close to 20% as well.
Yes.
What's your view on that name? Either these 2 stocks or another one if you want to give us.
No, again, I would refrain, but I think that, let me put it this way, that, there's been a lot of fear about AI. But as you mentioned, companies like Bajaj Finance, and full disclosure, we own it.
Yes.
Right? Have been early adapters of AI. And I think what's going to be interesting going forward is that there will be companies that will adapt quickly and benefit from it, and the ones that will not. So there will be, in the future, divergence in valuations of companies that actually use AI to their advantage, either to cut cost or to improve growth, either which way, or a combination of both, right? So I think it's going to be very interesting which companies are able to integrate AI into their business processes to really improve their competitiveness. And the ones who do will actually do better than the others. And that's where I think the men and the boys will get separated going forward.
And you'll be optimistic on the prospects of a company like Bajaj Finance from here on with due disclosures?
We would.
All right. And just one more point, gentlemen. Maybe I was watching you all on television in 2008, but the high that the markets made, the Nifty made, was 6,357 on January 8th, 2008. And we saw that level after that only in December 2013. I had a memorable day on January 8th, 2008, which I'll tell you in the break. But that's the reason I remember that. So we went through that 5-year period of not going to those highs. Hopefully it doesn't happen this time around.
But good. I think you're setting the expectations that people...
No.
The other point is, once this Iran thing stops, right?
Yeah.
You're going to go back to the AI story. And that's what we were kind of worrying about, if you remember.
Yeah.
Almost, that was another kind of war.
Yes.
This is one war, that is another kind of war. And that is war now, which perhaps there is no end date to it, right? There's no expiry. Here we are saying, well, it'll get end. Will it end tomorrow, next week, whatever, right? But that is like here to stay.
Correct.
That disruption.
Correct.
Right? And now we're ignoring it, but there are things happening there.
Well, I think, it's like any other disruption. It's just that the scale is going to be far bigger, right? I mean, if you remember when e-commerce companies came and what happened to the mom and pop retailers, or when EVs suddenly came on the scene and everybody derated the ICE companies. But what happens usually is that whenever there is a disruption, we tend to over-discount the risk in the short run and under-discount it in the medium to long run. And I think that's also what has happened in IT services, right? So I think even within IT services, there will be companies who will actually benefit from AI, and there'll be ones who don't adapt very quickly, who will actually, get into oblivion or irrelevance. But that will happen over a period of time. It's not going to happen today. But the market tends to take the worst case and bring valuations to that. And then there is an adjustment as people fear, oh, it's not as bad as we thought, or maybe. And what we forget is that companies can also adapt, right? So when EVs came, people, as I said, you massively derated all the ICE companies. But look at who's leading the race today. It's not Ola who came and disrupted. It's actually TVS and Bajaj.
Yes.
And you have a new player like Ather, who probably came from nowhere and has done phenomenally well. So I think something like that is also likely to happen, where the existing incumbents will adapt. Maybe they will acquire, right, capabilities and actually benefit. And there'll be some who will be fallen by the wayside. And I think that's where the opportunity and the risk is. You'll have to find those guys who you think will adapt well.
And that adjustment period is always painful, right? I mean, you kind of sell off hard, and then you spend, you kind of, market perception changes. I mean, it's also the interesting thing about markets.
So you would be looking to get into some of these IT names?
We would.
I think he already has maybe exposure.
What's the exposure?
We have some exposure.
And you'll look to build on from here?
And we will look to build on, because I think that's a great opportunity as well.
All right. Hiren, thanks very much for dropping by.
Thank you.
Always a pleasure, and thank you so much. Okay, all right. I think just a quick word on the market, which is now, I mean, it's so light that you will get these sharp moves. We're up about 70 odd points, but because there is so much uncertainty, I mean, expect those sharp moves to fizzle out and then reappear through the course of the day. So it's that kind of a day where it's continuation of the same third week of the war, but in terms of shock value, there isn't anything new. So that uncertainty is there without the immediate shock in that sense. Well, at the 21st edition of the IBLA, that is India Business Leader Awards, Entrepreneur of the Decade and Chairperson of Aditya Birla Group, KM Birla, revealed that the company's next cement unit commission will make it the largest selling cement company and the second largest in the world by capacity. Just want to play out some sound bites.
Our next cement unit commissions in 2 weeks. With that, we reach a capacity of 200 million tons. Thank you. That makes us the largest selling cement company anywhere in the world. It also makes us the cement company with the second largest capacity anywhere in the world outside of China. That's a matter of great pride for all of us. A large part of that group, of that growth has come in the last 10 years.
Okay, well, that is Mr. Birla. Now, let's, as I said, the big focus point is going to be supply, gas supply to industrial units. We'll have to track it closely because you're getting stray reports from here and there that gas supply is affected. I'm not just talking about LPG, but also, in that sense, natural gas as well. Vinny Mehta is DG of Automotive Component Manufacturers Association of India. And we also have Uma Shankar Mahapatra, President of the Indian Specialty Chemicals Manufacturers Association. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Mehta, if I can start by asking you, sir, a simple question to both of you to begin this. What's the situation? Have supply and where are supplies at on average for your members?
Good morning, and the situation is definitely concerning at this juncture. And, post the 2 notifications from the government on LPG and the natural gas, the problem is that the industry, the supply is intermittent in certain places. It's not there in certain places. So definitely the production is challenged at this juncture. There are many functions in the industry or operations in the industry that are very energy intensive. And therefore, there are challenges, especially when you look at forging, castings, Not just that, chemicals, derivatives of petrochemicals, they are all in short supply and the prices are going up. And not just that, not just the gas part of it, even aluminum scrap, some of the suppliers have declared force majeure. So like there are tier 1s, tier 2s and tier 3s, various people in the value chain or the supply chain facing different kind of challenges in their operations. So definitely it is a challenging time for the whole industry at this juncture.
Mr. Mehta, what we're talking about is LPG, sir?
No, I'm talking about not just LPG. There is LPG, there is LNG, there is propane, and
so
this
across
is the gas
the board,
part of,
across the board there is some disruption.
Not just the gas part. I'm saying there are many kinds of chemicals, and not just chemicals, even import of scrap, aluminium, they are under stress at this juncture. And the auto component industry is also a very export competitive industry. So we also have challenges in terms of export at this hand because, you know, the customer has deadlines and you get penalized if you do not meet those deadlines. So the challenges
just to look at the gas thing, Mr. Mehta, for 1 minute, is it possible to give us a number? I'm sorry, I mean,
no, there is no number.
Okay, I won't press you then because it's,
I don't have a number because
exactly. That's fine.
Regions have different, have different functions in the industry, you know, and each consumes differently.
That's fine. You said some companies in the supply chain have declared force majeure. That is on account of unavailability of products or again because of the gas issue? Just trying to be as specific as possible, as much as you can.
Both. You know, you could have challenges in front of availability of gas. And let's say if I am into thermal management and if my supplier down the line is not able to give me aluminum because they're not able to import aluminum scrap, it's a challenge at hand.
All right, Mr. Mehta, just to close the loop, you briefly mentioned even logistical problems. You know, that would be another big factor out there. So if you could tell us in terms of container availability and the pressure that's being faced out there.
So again, the ports are clogged. There are no containers that are available. The export routes, say if we were to go to Europe, where we export almost 30% of what we export, you have to go down the Cape of Good Hope, that's Africa, and go to the Europe. So not just the times have gone up, that is the time for delivering has gone up, but also availability of containers, because you will take much longer time. The containers will be on sea for a longer period of time. And these are all kinds of challenges. So logistics costs, costs due to non-availability of containers, demand supply issue, costs because you will be on sea for a much longer period of time, and then the risk and the insurance costs, everything is going up. So the costs are going up multifold, 2 to 5 times.
Yeah. Let me get Mr. Umashankar Mahapatra into the conversation as well. Mr. Mahapatra, I mean, some questions remain the same, but we want to get a sense from you in terms of what your industry is facing, sir.
Thank you. I think problem is very similar. ISMA is actually association of many large, small, and medium-sized, specialty chemical manufacturers of India, primarily from western part of the country. And we are facing very similar issues, and our members, it's not very specific to gas directly, because many of them have other fuel sources as well. Like for me particularly, like say I am working for an organization called Pulcra Chemical, which is a German chemical company. So we don't use LPG or any gas as our energy source, but many of our suppliers they use. So they are facing a lot of challenges. And the price impact is not in single digit. In some cases, it can be even double. So that is the problem we are facing. So all petroleum derivatives has impacted our packaging materials. So specialty chemical, you need a lot of HDP drums or, those kind of packaging materials are also in short supply. So it's not only the price, we are not getting the packing material as well. And the impact is also in the downstream, because we supply to a lot of export-oriented unit. For like say textile, leather, you have the specialty fiber manufacturing, you have water treatment chemicals, which is supplying across various industries. So impact is very huge, and our guys are also using a lot of ethoxylated products. Those are primarily coming from ethylene oxide, and those prices has gone up significantly. So there is a significant challenge. But it's depending depending on how much stock you have in your hand, because this problem is for say last 2 weeks. So if somebody has got enough material covered for their at least for next 1 month, they are little better off. But those who are working in a very just-in-time inventory, they might have more challenges, because getting the material, finding new alternate source, those are the challenging. Somebody might have more material.
Yeah,
in store,
Mr.
but
Mahapatra, in terms of in the specialty chemicals industry which you represent, this is in the inputs that you use. I'm not talking about the petroleum derived products, right? But energy. This is largely it's dependent on what kind of fuel, sir.
So primarily, I would say the specialty chemical per se sometimes is not very highly energy intensive in our case, because these are primarily formulation or mixing, sometimes reaction, but not very highly energy at our end. But our supplier will have a lot of impact. So we are facing not at our end. It's primarily from the supply chain we are facing the issues. Our manufacturers, our members at in-house, we don't have much issues. But the problem is getting the material on time. The raw material supply chain is a big challenge.
Okay, and could you, could you give us a sense of which are the main pain points with regards to these, chemicals where there is product availability issue and price surge, etc. Just 3-4 item heads, sir. We're not chemical specialists, neither is the audience, but just to get a sense of where this is turning out to be a big pain point.
So major is the plastic derivative, because anything related to plastic, it could be packaging in drums, it could be packaging like LDP or HDP or anything plastic packaging, even in the consumer goods, that will have an impact. So packaging is a major challenge, which is a purely petroleum derivative products. Lot of detergent and surfactant, those are also coming from ethylene oxide, which prices is going high. Supply is not a problem right now. The prices is really very, very high. Lot of polyester derivative, silicon related products, so multiple products, and the more importantly is the acid. Lot of acids are being used in the chemical manufacturing process and also in the downstream process. So acid is in short supply and price is almost double. So these are the very specific product, but all the products prices has gone high, and this particular 3-4 products is really out of control. So we cannot,
And when you say acids, what are the kind of companies which use this, sir?
I think everyone will need acids in some form. Like say for our case, you need something for neutralization. For our textile industry, they will need it for neutralizing anything you do in the process, alkaline process. You need to neutralize it with acids. So it's a very important ingredients both for manufacturing and also in the application stage. So acid is a real challenge right now. So the price impact is almost double there. And transferring this price to the downstream industry is also a challenge. We can understand our customers, they have already booked the orders from retailers or brand for a longer period of time. So you cannot transfer the entire price rise to the customer. So that will become a challenge. And even if the conflicts get resolved, we hope it gets resolved very soon. But still, the supply chain will take time to get streamlined. So impact will be there for some time, some more time to get streamlined. So,
Mr. Mahapatra, just a quick point. Oil is coming, right? We're getting crude oil. Oil availability is not a problem. Refineries are working. Our refinery. I mean, you buy all this. I mean, all these products that you mentioned, right? This comes from our refineries. So why is there an issue?
So some of the specific grade of plastics, it's imported also from Middle East. So there are certain grades available in India as well. So one side you have the price rise. So some grades are available, but price has gone high. And some specialty grade are also getting imported. So those are in short supply. So sometimes you need to mix two grades together to achieve a particular grade of plastic. So those are facing more challenge. Some grades might be available, but at a higher cost.
Last word to you, Mr. Mehta. Just wrap it up for us in terms of what we're likely to see if this were to go on, say, for another 10 days.
Very difficult for me to say, but definitely it's very, very challenging. But I very well understand that the government is seized of the issue and they are talking to various agencies. So I hope they'll resolve it ASAP. Otherwise, it's going to be a big challenge. And I must also caution that the small and medium enterprise are very badly hit because they're running into a working capital issue also. And that apart, we are finding problems with the migrant labor also. They're going back home because cylinders for cooking at home are no longer available for them. They buy it off the shelf from these smaller stores. So we're running into a problem at the labor front also. Yeah.
Yeah. Well, why labor, Mr. Mehta? Sorry. What's the issue there? Yeah.
Two issues. One I said is on the working capital issue because of what Mr. Mohapatra mentioned. For smaller companies, it's a big problem because the payments get stuck because there's a delay in the whole chain now. And secondly, there are a lot of migrant laborers that we employ in the industry. We are a very labor-intensive industry, and those smaller cylinders that you have that they cook at home, they are no longer available in the market. So how do they eat at home? So they're going back.
Yeah. No, point taken.
We need people to work in the factories as well. We cannot run our canteens also.
Yeah. There's a lot of fair bit of disruption in that sense. Mr. Mohapatra, just one last question. If you can give us feedback on how, stuff that you buy from Indian refiners, etc., the industry that sources it, that is not disrupted, right? There is no problem there.
So far, no. It's only the price rise. So supply is still there. Only we are facing challenge. Everyday price is changing. So we are unable to give a right clear-cut price list to our distributor or our customers. So we cannot change every day the price. That is a problem.
Yeah. Got that. Thank you very much for joining us, and it's a pleasure speaking with both of you. And we will sort of have you back on with more as time passes by. Hopefully, we won't have to, and this situation resolves and everything goes back to normal, but we never know. We'll take a break. The management of Hudson Agro joins us to discuss their 527 outlook and the road ahead. Stay tuned. Coming up.
Welcome back. This is Corporate Radar. Well, at least some green on the screen for now. The Nifty is holding with a gain of around 80 points, but things still very, very fluid. And the other good part is at least the number of stocks advancing has crept up a little bit to around 1,200 stocks from around 700 stocks earlier. Well, let's welcome our next guest. We have Mr. R.G. Chandramogan, the chairman of Hudson Agro, who joins us on the show. Hi, sir. Good morning. Good to see you, and as always. And thanks a lot for speaking to us here on CNBC-TV18. Before I come to you, I just want to highlight the three broad points that we're looking at. One is the demand environment on ground. The second point is the milk procurement prices. And the third, the regulatory environment. Let's address the demand factor first, sir. How has demand been in the quarter so far? And if you could give us a sense about the outlook for FY27. If I look at your numbers, the 9-month revenue, including the acquisition, your revenues grew by close to around 14%. So mid-teens growth is what you've done. Where do you end this year? And what's the outlook for next year?
The milk prices of late has increased a little higher. The reason is actually the lot of fat got exported from India to abroad. And normally fat is not exported from India. It's only SMP that normally gets exported. But this year, due to better prices, SMP didn't go, but the fat went on. That created a fat shortage, and it also applied pressure on fat prices. Coming back to our own procurement, we have done well, and the unit that we have taken over is also getting amalgamated now, and probably by this month end, this will be only a standalone report and not a consolidated report, and it is already merged. Initially, we had difficulties in bringing the company into the requirement of us, and probably we are now able to control it better. The volumes have increased and things are getting better. Actually, we are now close to 10,000 crores on the run rate. Hope we will be able to achieve plus or minus 1% or whatever it is. Not even 1%, plus or minus 0.5% we may achieve or we may not. Milk prices have recently increased by about 8 to 10%. And the price increase has been given an effect only in the recent, a week back.
All right. So you're saying procurement prices are up by 8 to 10%?
Sorry?
Milk procurement prices are up by 8 to 10%?
Almost 8%. And price increase is almost 6%, you can say.
Okay, got it. So you'll end this year with closer to around 10,000 crores of revenues going by the current run rate?
Stability is not clear. My system is having some problem, I don't know.
So, sir, going by the current run rate, you briefly mentioned a revenue number of around 10,000 crores. You end this year with closer to that number, correct?
We are on track to reach that, but probably, as I said, plus or minus
here or
half a
there.
percent. There may be a miss, or probably we may hit it. We are not sure about it.
All right. And on that base, what kind of growth can you look at for the next year?
Next year, we are expecting a good thing, but probably the war has to stop, and probably right now the plastic raw materials are not available, and probably there is a premium getting attached, and 30 to 40% price increase is already on the cards. And we are not in control of the packaging material. We are working on it, and we don't know how far this will just lead to little inflation in the selling price of products.
So the war impact is impacting your packaging material, and the prices have spiked up there, and availability as well is a bit of an issue. Is that correct, sir?
That's right. Packing materials have increased. For example, we require gas to produce wafer cones, but we are finding it difficult to get. But the rest of the materials, we have our own unit to produce polythene films that we are comparatively safe. We are in a position to manage till next 1.5 months. But before that, probably things have to improve.
All right. So you have some inventory on that front. However, on a couple of other, like cones, I believe, is where you're getting a little bit impacted. Right, sir? So, but for the next 1 month or so, you can still sustain operations with a decent amount of profitability that you were seeing in the previous month.
That's right.
All right. Reports also suggest that the unorganized industry may come under the FSSAI lens. How would that benefit a business like yours?
Somehow, probably the audibility is not clear. I don't know.
All right. Let me come again, sir. Am I audible right now?
Okay. Probably not so clear, but tell me.
Let me try again, sir. Reports suggest that the unorganized industry may come under the FSSAI lens. How would that benefit a business like yours?
May be good for the organized industry in a way. Probably things gets regulated and compliance becomes easier, and probably the complication of small guys manipulating will stop. I think probably it's a good move.
Okay, all right. So it will have some kind of a tailwind for organized players. Let's get back to your business then, sir. And we're looking inward now since, there are various parameters at play. How is revenue from value-added products growing for you? What is the current share from milk in comparison to other products?
We are not in a position to give the breakup. Basically, milk is the core value for us, and milk is giving the operations efficiency for all other products. Right now, milk is actually growing in a better manner because we are only into the consumer business and not in the HoReCa segment. We don't give credit, and our receivables are zero. And in fact, when HoReCa is affected, most of the people tendency is to consume it at home. So this may be making an impact on our sale in the next 20 days or till the war stops. There may be an incremental sales that is likely to come, but it is yet to be gauged.
Okay, all right. What about your diversification, sir, geographically? What is the share of sales coming in from, outside of Tamil Nadu and as well as in Maharashtra? If you could give us a broad breakup. What is it right now and where is it headed?
Now, outside of Tamil Nadu, right now, we are almost at 45%. And this is likely to come to 50% in the next 2 years. We are actually using the capacities built over a period, now getting it better. And the coming year will be much better because the capacity utilization is getting enhanced, as a matter of fact.
Okay. A quick word on profitability, sir. Targeted spends on advertising. I think you were spending around 2% of your revenue on advertising. So where is that likely to stabilize at? And given the fluctuation in procurement prices, what kind of gross margin should we look at? Your last reported number was in the vicinity of around 29 to around 30%. Please go ahead.
Our margins are always better because of the type of model what we have built. See, we have got 4 brands. All the 4 brands are market leaders. Arun Ice Cream, Arogya Milk, Ibaco or Hudson. We are also not focusing on Horeca. The reason why we are able to get a better margin than the peers, almost our margins are 1.5 times to 2 times the margin of our listed peers. The main reason is actually we have our own distribution where we have formed a network of around 4,500 outlets across the country, where we do not have a major wholesale distributor, and all the distribution is happening through our own outlets. So this is something unique, which is actually giving the better margin. But at the same time, probably it calls for infrastructure, and we have made infrastructure investment, and that has just really made our depreciation very high. Over a period, this depreciation or interest will fall now. We are already at the debt equity ratio of less than 1:1. And this is, earlier probably we used to be at 1:2 or 1:3. Now it is under 1. And we hope things will start improving further from here.
All right, sir, we leave it there. It's always a pleasure speaking with you, and look forward to the next one. Appreciate it. That's Hudson Agro. Stocks up about 0.5% or so. We've got the market, which is, as I was saying earlier, you will see these easy rises and then easy sell-offs as well. When I say easy, I mean, quickly and very blink of an eye, you kind of go up and then come down. The market's light, and I think that basically is the underlying setup out there. Nagaraj Sethi is with us of HDFC Securities for a quick technical view on things. Nagaraj, good to have you with us here. Thanks for joining us. So what's the trade? Indices first, and then we'll get to stocks.
Hi, good morning, Prashant. Yes, rightly said, market is not sustaining the high. The lower tops, lower bottoms on the chart is indicating the weak inherent strength. The opening downside gaps which are still open. The overall chart pattern is indicating we are in a bearish trend, and this just a small pullback rally from the lower levels. Anyhow, market is at the support somewhere around 23,000 level, 23,100, 23,000 levels. So any pullback rally up to 23,500, 450 is going to be a sell-on rise opportunity, and after that market could come down further. I wouldn't be surprised if the market read down to 22,800, 700 levels in the near term. And I have 2 stocks. One is from a long side, one is from a short side, both extremes. Timken India has been in a constant up move over the last few weeks. Higher tops and bottoms. Now it is placed at the edge of upside breakout. One can look to buy at this point of time, currently trading around 3588, 3590 levels. So 3800 is going to be a immediate upside target. One can place a stop loss at 3500. And second one is from a sell side. Bandhan Bank, chartically Bandhan Bank after a stellar up move has shifted into a consolidation. The chartically it is indicating a formation of a triangle pattern, a descending triangle pattern, which has a bearish implication and currently breaking below the neckline of the pattern, which is indicating a negative outlook for the stock price. Currently trading around 172.75, 172.50. One can look for a short in this stock price, and 162 is going to be the immediate target, and one can place a stop loss at 179 to 180 levels.
Okay, all right. Thanks a lot, Nagaraj, for joining in and giving us the view with a couple of picks as well. Let's focus on a couple of stocks then that are buzzing around. In IDBI, that's the stock of the morning on the downside. Gaurav joins us to give us a quick update on that one. Gaurav?
Well, it's not a good day for IDBI, and the reason being that for the last few years, we have been seeing that IDBI was at a forefront when it comes to government's divestment plan. Now, this time, there was a concrete plan, and government was also talking about the divestment likely to be concluded in FY26 or FY27. But what the latest update is that, as per sources, the bids that they have received are below reserve price, and that is the reason why the divestment will not be concluded. Now, if you look at the structure, government along with LIC holds more than 90%, and they were going to offload around 60% stake for a valuation of around more than 30,000 crores. Now, as per sources, there were 2 prominent bidders, Emirates NBD and Fairfax. Even if you look at the background, recently we have seen Emirates NBD entered into RBL, and if you look at Fairfax as well, they already own a bank which is CSB Bank. Now, sources say that as the bids were lower than the reserve price, that is the reason why this will not go ahead. And again, this divestment plan will be delayed. If you look at the IDBI Bank's share price as well, in the last 1 month itself, barring today's fall that we have seen bank failing almost by 17% in terms of share price. There could be multiple reasons. Now the war was also ongoing, which also impacted. But given that this plan is again delayed, we are seeing another major reaction. As we speak, the stock is down more than 12%.
All right, thanks very much for that, Gaurav. IDBI Bank 14% lower. Manisha joins in on the other side with a sort of quick eye on what's happening in the commodity space coming up. Okay, welcome back. Let's shift focus to commodity markets. And Manisha is here with what's her focus on. Of course, it's got to be the underlying dynamics of this Iran war, which is into its third week. But Manisha, take it away.
Oh, well, exactly. Crude it is, because we've seen $106 a barrel in the early morning trades in Asia today. And as you said, it's a third week that we are getting in with the conflict still continuing in the Middle East there. And the U.S. strikes on military assets on Karg Island is something over the weekend that this is an area that actually sees export of nearly 90% of Iranian oil. While we do understand the hit only has been at the military bases and not oil facilities, but Iran does say that if there is any attack on the infrastructure, it would trigger a retaliatory attack strike on US-linked energy facilities there. And that's exactly what the markets seem to be reacting to. Having said that, the prices are slightly off highs on the reports that US could announce a coalition of countries to escort the ships through Strait of Hormuz. Apart from that, when you look at the overall inventories, we have seen slight gains onto that one as well. And there is oil loading operations in Middle East at Fujairah resumed. So a couple of reasons that you haven't seen crude prices surge beyond 106 there. There also is a statement from IEA suggesting that the 400 million barrels that have been agreed upon will be made available, especially into the Asian countries, with immediate effect. That also seems to be capping the prices at this point in time. But there are long-term implications that the markets believe that this could have on the global markets therein. And also, when you look at the supply that is expected to decline by nearly 8 million barrels per day from the Middle East, which is 8% of the global oil supplies. This is the highest ever disruption that we have seen in history when it comes to global markets therein. And I'll quickly take you through some of those really. The first one is 1973-74. That is when we saw the Arab oil embargo. At that point in time, the oil loss was 4.5 million. And we saw the crude oil prices gain up from nearly $2 to $11 a barrel therein. And then you had the 1978-79 Iran revolution. At that time, the production loss was 4.8 million, and that was 7% of global supply. And the crude prices had gained up by nearly 50%. The third instance that you saw prices gain quite strongly was during the Gulf crisis in 1990-91. The production loss at that time was 4.3 million, and you saw the crude oil prices gain to nearly $36. This was nearly from $17 a barrel. And then remember, it was those hurricanes, Katrina and Rita, that came in 2005. At that point in time, the production loss was 1.53 million barrels per day. The Russian invasion on Ukraine was in 2022. At that point in time, there wasn't a loss immediately, but the prices did gain 50%. And we saw the prices go all the way up to nearly $130 a barrel therein. What the street is looking at right now is that at around 8 million barrels per day of a loss is the highest ever that you have seen. The other thing that you're looking at with the crude oil price rise is the mining price that have continued to increase. So this is a data that has come in from Wood Mackenzie, which says that with every 10% rise in case of crude prices, the mining cost impact on iron ore is up by 4%, copper 3.5%, and gold at 2% as well. Now, when you look at the crude oil prices at $100 a barrel and assuming that it continues to average there, in that case, you could be looking at iron ore mining costs gaining up by 20% year-on-year basis, copper by 16%, and gold by 9% as well. So it's not just crude oil that we're looking at, but various agriculture, fertilizer, and mining costs as well going higher.
All right. Thank you very much, Manisha, for that, and something to continue to track. As you know, some of the guests earlier in that discussion told us as well. More later. We'll take a quick commercial break here. Latha speaks with Macquarie's Suresh Ganpati on the recent sharp sell-off that we've seen in banks and led by private banks, mind you. Nifty Bank was down 7% in the last 5 trading sessions. What's worrying that space? Chat coming up with Suresh.